very expensive. So, all right. Well, I think we'll go ahead and probably get started. Thank you for joining us on the new practitioner financial literacy series. It's designed for new podiatrists just to kind of learn about some interesting topics when it comes to your money. Today, we are going to talk about the basics of investing, and our speaker today is Matt with Principal Financial. So I'm going to turn that over to Matt and go ahead and take it away.
Thanks, Randy, and thanks again for having us. It's a privilege to be here, and whether you're watching live or on replay, this is one of my favorite presentations to give. It's going to be very high level, but my goal is always to give people a couple of takeaways that can be actionable and they can take forth and put in the recipe for their future investments and hopefully have some more knowledge than what you had coming into this. So, as Randy said, my name is Matt Banzhaf. I've been a financial planner for 14 years, going on 15 years. You can see there I have a couple designations behind my name: certified financial planner and accredited investment fiduciary. But really on the getting down to the basics of investing, to me, the best analogy that I've come up with is KISS. Keep it simple, stupid. And hopefully we'll give you some takeaways, like I said, that you can take forth and deploy into your investment strategy and retirement plan. So 5 important ideas to get you started. And these are all very controllable things. So 1, investing early and aligning your goals, diversifying your investments, knowing your risk comfort level in your years until retirement, keeping your investment selection in line. So, a common word that's thrown around is rebalancing. Well, what does that mean? And most importantly, I think number 5 is avoiding emotional decisions. The Warren Buffett has a quote: our favorite investment is a forever buy. And making sure that you're staying the course. And we'll have some really good slides that talk about this, but that's usually the biggest thing that can be a hindrance on a portfolio is human nature coming into play and making the wrong decision at the wrong time. So the importance of investing, why do we need to invest? To potentially grow our savings. Most importantly, keeping ahead of inflation. On this presentation, they have an example of from the U.S. Bureau of Labor of Statistics that talks about the buying power and over the last 20 years. Now, this study was done in November of 2019, so this would be even greater today with the recent inflationary environment we have. But 20 years ago, $1,000 would spend like $1,528 today. So that would have been from 2000 to 2019. If I had to extrapolate that forward to the inflation that we've seen recently, I would say that 1,000 from 2000 is probably closer to 1900 or 2000. So having investments is how you can keep ahead of inflation. Taking advantage of one of the most powerful things, compounding earnings and interest. And then also knowing the risks of the investments and where you're putting your money is very important too. So investing early and aligning your goals. No secret that the earlier you invest, the more time you have to save. I always tell clients it's about time in the market. You can't buy back those early years, even if it's putting in $50 a month to a Roth IRA, for example, and slowly building up that amount that you're contributing to it as cash flow frees up. I know as a young practitioner, one of the biggest battles early on is, do I save or I invest? I think that it's somewhere in the middle where you do a little bit, or should I invest or pay off my student loans is what I meant to say. And I think it's a combination approach, but the earlier you invest, the more time you have to save. So what they are showing here is Sam contributing starting at age 25. And then if he had waited until 40. So if Sam started at 25, over a 30-year period, he would have put in $39,000. And his investment value at a 6% average rate of return, that 39 would have grown to 106. If he waited until he was 40, he would have put in 19,500, and his growth would have taken him to 31,200 by the time he was 65 at the same rate of return. So you can see here, put in half as much, but has less than a third of what Sam at 25 would have had at that point in time. The benefits of saving more can add up. A lot of 401ks now have what's called an auto escalator, where you can tell it every year, take my contribution up by 1%. This is simply showing the difference in a 6% deferral and a 10% deferral. Now, on a per paycheck basis, if they're using 30,000 as annual income, obviously the gap would be higher the higher the income was. But in this scenario, it'd be $1,200 a year. If you think about that over a 26 pay period, that would equate to about $40, $50 a month. So, every little bit is going to add up long term. And the more time that you have for that to compound, the better off you're going to be and the better results you're going to see. So the magic of compounding interest, I've had this slide in the deck since I think 2014, but it is my favorite one. So if I were to give you two options, option one, I'm going to give you 30 payments at $1,000 a day, or I'm going to give you 30 payments and we are going to double it each day and start at 1 cent on the first day. By that 10th day, it's up to $5.12. And then it's just going to continue to double from there. More than likely, which one's going to be more. But, if I would have thought this as a 22-year-old coming out of college, I might have selected the first option. But you can see that difference. Option one, you would have 30,000. Option two, you would have over 10.7 million. So that really shows you that compounding interest and how that can ratchet up. And you can see here on the chart, it's not until probably about payment 7 that you would even be over $1. But that compounding interest just continues to ratchet up. This one just also hits home on the power of compounding interest. So what this is showing is over a 10, 20, 30, 40-year period, if you had put in on the first year $10,000 investment and you just let it sit and cook, kind of like a crock pot meal, and what the different value you would have at these rates of return. So at a 6% rate of return, if you divide your rate of return by 72, that's going to tell you how often your money should double. So on a 6% rate of return, your money would double every 12 years if you average that. 5 years, it would be a little bit longer. 3 years, it would be more. But you can see the power of that compounding interest adding up over a 40-year period. And again, you only put in an initial investment of $10,000. So again, time in the market is very important. Even early on, getting going, practice, trying to pay off student loans, making sure that you're taking advantage of an employer matching contribution. I'm a big believer of a Roth IRA for people, even if it's $50, $100 a month, that it's hard to equate the head start you're giving yourself by starting as early as you can. So diversifying your investments, what does that mean? One way to think about it is not having all of your eggs in one basket. So what I'm showing you right now is what I call grandma's quilt. And what this is going to show at the top is each calendar year, and then below it, it's going to have the different asset classes and the returns that they produce in that calendar year. What you're going to see is it's very scattered. So if we look at 2005, the best performer was commodities. Then you look at 2006, it was the worst performer. But the common theme that you'll see is kind of always in the middle every year is going to be a nice diversified portfolio. So it's going to help remove some of the market risk from a large loss exposure and make it a much smoother ride, which makes it a lot less emotional ride when you can have it be a little bit more smooth sailing. And it's also very true where if you don't lose as much money, it's easier to make money. If you lose 20%, it takes a lot more than 20% to just get back to where you were. So if you don't lose as much, it's easier to compound that on the upside. This chart is just showing the same thing, but from 2014 to 2023. one consistent theme you'll see here, and these market from 2014 to 2023, we saw one of the better bull market runs. You'll see the large cap growth did very well, but again, in the middle, diversified portfolio is just going to give you a much smoother ride. So this next slide is going to talk about that. So option one, you invest 100,000 at 6%. In option two, you invest a fifth of the portfolio or 20,000 and you lose it all. The next 20%, you're going to get no interest. So on that 40,000 at the end, you're going to have 20,000. The next 20%, you're going to get 4% interest. The next 28, and then the final 20, you would get 12% interest on. Which of these options would you pick? And what it's going to show us is the value at the end of the 25 years in each scenario. So at 6% interest, you would have taken your 100,000 and you would have doubled it a few times and had 429,000. Option two, you would have had 550,000 at the end of it, even though 40% of your portfolio you lost 50% on. So this just shows you the impact of diversification and the importance of it, where you have things that aren't necessarily correlated with each other. A good example would be in 2022. We had our 20% market downturn. The large cap growth tech stocks, so like Apple, Microsoft, those did the worst. They were down 30-some%. But then in 2023, they were by far and away the best asset class in that calendar year. Whereas something like a large cap value in 2022 was maybe down 2 to 5%. That would be like a Walmart, John Deere, be invested in those types of companies. And in 2023, it was probably positive 9 or 10 when tech was up 30-40%. So not having all your eggs in one basket and having a good diversified portfolio is a key ingredient. So knowing your risk and comfort level and your years until retirement or until your goal for what you're setting aside these funds for. One rule of thumb that I think is pretty good from how much equity should I have and how much more conservative bonds, fixed income should I have. If you take 120 minus your age, that's I found to be kind of a good guideline. So if you're 30, that would say you should have at least 90% of your portfolio in equities. What I will tell you is if it's a 401k or a retirement plan and that's long-term money, probably don't need to incorporate bonds or fixed income into your portfolio, I would say, until you're at least age 40. Equities are going to give you much higher long-term rates of return. And if you pick good, solid investments, 2 out of 10 years in the market on average are going to be not so great. The other 8 out of 10 are going to be pretty good. But what this chart is showing is just that investing has become increasingly complex and that you need to take on more risk to achieve the same returns as what you would have in 2004 to 2013, for example. So what it's saying is that you did not need to take on near as much risk to achieve an average 5.5% rate return. In the most recent market cycle, you're starting to have to take on more risk to achieve those returns. So it's become a little bit more complex, but I'm going to give you some ideas that I think will make it a little bit easier. So years to retirement can affect your risk to retirement. On the low end, you have money markets, what are called bonds, fixed income, and then you have your U.S. equities. A little bit more risk would be small, mid-cap U.S. equities, so smaller companies. A small cap stock would be Casey's General Store. A mid-cap stock would be Principal. And then a large cap would be Walmart, Apple, Microsoft. And at the very high end, you have international equity. Now, we're just covering the broad asset classes here, but this just gives you an idea of what's lower risk and what's considered higher risk. For the most part, the investment vehicle that a large portion of your investable assets are going to be in are what are called mutual funds. What a mutual fund is it's a investment that has a specific investment objective based on what type of mutual fund you're buying. So if you're buying a large cap equity investment, more than likely you're going to have 40 to 50 different stocks inside that mutual fund wrapper that are going to own, in a large cap growth strategy, Microsoft, Apple. So mutual funds are great in the fact that they're going to give you some diversification on in itself, because you're going to own a basket of different stocks underneath of it. Mutual funds are also going to have bond options, which what a bond is you are, instead of buying equity in a publicly traded stock, you are buying debt that you are going to be paid back a dividend and eventually be paid back at least your investment, your par value, or potentially some room for growth depending on what interest rates do. But bonds are going to be much more conservative than your equity investments. Some other investments that you'll see are individual stocks. That's something that we typically see in what's called like a non-qualified portfolio. Inside of an employer 401k, you're going to have an investment menu that's only going to be mutual funds. Another big thing has become what are called exchange traded funds. What is different from those in the mutual fund is ETFs are going to trade like a stock, meaning you have a price throughout the day while the market's open, and it's going to have a basket of stocks underneath of its wrapper. Whereas a mutual fund doesn't have a price throughout the day when the market's open. It just has an opening price and a closing day price. So access to these funds, the easiest is always going to be bank products, CDs. Mutual funds would be the next thing. You can incorporate those in, obviously, in your 401k, Roth IRA, in a non-qualified, just an investment account. Bonds and stocks, and then the hardest is 401k. You have to have an employer plan to be in that. I won't spend too much time on this slide. The difference between a 401k and a 403b. A 401k is going to be a private company. A 403b is going to be if you work for a hospital, municipality, state or local agency, is going to be a 403b. The only difference is a 403b, you are immediately eligible to enroll. A 401k could have a waiting period. But the advantages of these is tax advantages, automatic deduction. One big takeaway I would tell you is automate your saving strategy. Just set that stuff up, set it, forget it, out of sight, out of mind, and then revisit that and look for opportunities to add more to what you're contributing. The different ways you can save for retirement: pre-tax contribution, which means your money's going in before you're taxed on it. So if you're putting in $100 a pay period, it may only feel like $85, $90 out of your take home because it's going in before you're taxed on it. Now you'll pay that tax when you take it out in retirement. Whereas a Roth is the exact opposite. You pay tax on it now, but that growth is tax-free forever. And then when you pull it out in retirement, you don't have to worry about what future income tax rates are. If you're new and just getting done with school and starting out in your practice, likely your income is going to continue to go up the longer you work. While your income is lower, sometimes it does make sense to me for somebody to be funding a Roth, because you might not need as much tax deduction now, and you can let that grow tax-free forever. And usually we recommend people do a combination approach where they're doing some pre-tax investing and then also doing a Roth through their 401k or a Roth IRA on the outside. Okay. So selecting your investment options within your retirement account or a Roth IRA or whatever investment account it would be. You have usually two options. You can do a pre-built portfolio or build your own. A pre-built portfolio is going to be a target date fund or a retirement date fund where it's going to say 2050, 2060. These are great if you have no desire to go out and pick your allocation and maybe aren't working with a financial professional, because it gives you instant diversification and is professionally managed by whatever fund company that employer chooses to have as their target date funds. And then each year you get closer to that, they are going to make it a little bit more conservative. The common misconception is once I get to 2050, for example, is it all going to be in cash? They're anticipating that you would still be holding this throughout a long retirement. So it's still going to have some equity exposure, but this is a perfect way for investing to get started if you don't have any desire to pick your own allocation. Building your own portfolios allows you to pick the individual selections. Now, this is not an allocation I would say just take and run with. You would want a lot more large cap US equity, maybe downshift your international equity and your fixed income exposure. But when you're making those selections, it's always good to have a financial professional, I think, or stick with those target date funds unless you do your own research and want to watch it. So dollar cost averaging, this is something that you'll be doing whether you know what it is or not. So if you're in an employer plan, this is already happening for you. You're investing each pay period and you're buying at different points in the market. If you're doing Roth IRA, for example, and you're contributing monthly, you're doing this. Dollar cost averaging just removes a lot of uncertainty because you're going to be buying in at different price points, and it's proven to work in an up and a down market. So in this scenario, they're showing us both those cases. On the left, it's in a rising market. You can see that over that time frame, there would have been a 29% gain. In the declining market, your first buy would have been at $60 a share. Your last one would have been at $48 a share, which that would be right around a 20% correction. But even in that scenario, chart's one of my favorites. So it just talks about continuing to invest during difficult market climates. So it's going to show us two different scenarios. The first one is in 2000, somebody put in 100,000 and they didn't buy anything more. Over that 22-year period, they would have had a 6.3% average rate of return and a total gain of 304,000. The second scenario, they put in that 100,000 at the same time, but then continued to do systematic purchases of $500 per month. The big thing that you'll notice is they had an outsized return of 1.1% versus the person that just did a single purchase. So investing along the way can really increase performance and your total growth in the portfolio because you did put in 138,000 more, but you also had 458,000 of market growth over the first scenario. This goes hand in hand with that slide. The difficulty of timing the market. It's an impossible thing to do. Anybody that says they can time the market, they aren't being truthful to you. But this just shows the impact of a $100,000 investment. If you stayed the course, you would have had 326,000 at the end of that time. If you had missed the best 10 days, that 100,000 would have shrunk to 178. And you can see if you miss the best 20 and 30 days, 30 days I'll point out because you would have had less than what you had actually put in. So don't try and time it. Have a systematic, automatized investment strategy. And again, I would equate it to a crock pot meal. Your job is to put in the ingredients, keep that lid shut, and once it's time to eat it and open it at retirement, it's going to taste and be really good. So reviewing your investment options, this is another one that's important. I don't think that people need to be doing this monthly, quarterly. For my personal plan, I do this once a year. You pick good investments that are buy and hold, and you're checking on those once a year to see if you need to do what's called rebalancing. So reviewing your investment options can keep emotions in check. Check in annually, no different than just your standard wellness check. I'm not always the best about going to the doctor once a year, but the same principles can apply to your investment portfolio, just checking in on it once a year, revisiting if you can contribute more. And the biggest reason is making sure that you stay balanced in the risk profile that you want to be in. So this is a good example where you start to invest and you're going to be 60% stocks, 40% bonds. Given the last 10 years, bonds didn't really do much, but equities did really well. So now all of a sudden your allocation is 75% stocks, 25% bonds, and all of a sudden 2022 comes and the equity market goes down 20, 30%. Well, now all of a sudden you're taking on and have much more exposure to stocks than what you started out at. So looking at it once a year and seeing if you need to do is called rebalancing, which is just bring your asset mix back in line to that 60-40 portfolio. And again, I recommend just doing this once a year, not something that you need to be doing monthly, quarterly. If there's some big market movements, maybe twice a year, but again, for my own self, I do it once a year. So avoiding emotional decisions. This is where we really see people get in the way. And I'm going to show a chart of the S&P 500 versus the average investor in a couple slides. But timing the market, what would you do? If you were in the 2008, 2009 financial crisis and you had 100,000 and 1 year later it was worth 65,000, what would you do? In this scenario, somebody cashed out because they couldn't stomach it anymore, and they went into a CD that was getting them 2% interest. 5 years later, you would still be well below that 100,000. If you had stayed the course, 5 years later, you would have been well above that 100,000 that you started with at the beginning of the great financial crisis. So staying the course is always going to be the best recipe. I want to make sure I get that point across. Building wealth takes time. Investing in the stock market isn't going to be the most glamorous. I call it boring money, because that over 10, 20, 30 years, you're going to have a great probability of success and have some nice growth. So what this is showing is the S&P, and they go back to 1949. If I were to tell you over a 1 year time frame, 3/4 of the time you're going to make money, that's pretty good probability. It's a good bet. Over 5 years, that goes up to 83% of the time. Over a 10-year period, over 9 times out of 10, the market's going to have been positive. Over a 20-year period, there hasn't been a time frame where the market produced a negative return on the S&P 500. Markets are resilient, and almost every year we see a 10% intra-year correction in the market. What this chart is showing is the calendar year returns from 1980. What you'll notice in the clear lines is that there's 7, 3, 6, 9, 10 years since 1980 that produced a calendar year down return. The others were positive, but those little blue dots show intra-year the most of the market was down. And that's every single year the market at some point was negative. But again, most of the time it ends up positive. So making sure that you stay the course and aren't reacting to shorter term trends is very important. How do I save beyond my employer's plan? Almost holistically recommend Roth IRA. That is one of the best buckets of money that you can save into. It's the one place where you don't have to worry about future taxes on your growth, but Roth IRAs have a unique thing where you can access your contributions without any penalty as long as you've had it open 5 years. So it is one account where if you have an oh crap moment, that you would be able to access what you've put into that. Bank products, brokerage accounts, HSAs. If you have access to an HSA, fully fund that thing. I would put that as 1A, Roth IRA as 1B. An HSA is a very powerful bucket of money that you're getting triple tax savings on. So you're getting a tax deferral on the way in. It's growing tax-free, and it comes out tax-free if it's used for healthcare expense. So how much should we save? Retirees, a rule of thumb is you need 80% of your pre-retirement income. What I'll tell you is retirement tends to happen in phases of 10. If you have a 30-year retirement, the first 10 years, you're going to spend what you were living on pre-retirement. The next 10 years, that may slow down a little bit. The next 10 years, that slows down even more. If you have grandparents that are out in their 80s and 90s, they likely aren't doing as much. But a rule of thumb is 80% is what you'll need. How much should we save? I always tell people to target 10% of their income. I think it's a good rule of thumb, and then you just continue to try and work up towards that or work up past that. If that's not in the cards right now, because maybe you're paying off student loans, make sure you're putting in at least as much to get your full employer match, and then look for opportunities to grow that by 1% or add an extra $20 a pay period. All those little things will add up over time and be a good recipe for success. And with that, I am at the close of this. If anyone has any questions or maybe has some more specific questions that they would like to ask, please feel free to reach out to us. No strings attached. We're happy to help where we can. And if you're looking to engage in some more individual planning, that is something we offer. But again, feel free to reach out to us with any questions that you might have, without any strings attached. And all of our contact information is listed here. That QR code will take you to our website. Thank you, everybody, for your time, and hope you had a couple takeaways that you can take forth and take along on your journey for saving for retirement.
Thank you. Hey, do you have a moment for a question? Sorry, I know it's only supposed to go to one.
No, I sure do.
I might have missed the first part of this, but sorry, I was with a patient. But my question to you is, if we have current debts,
Yep.
meaning like, because I've heard different, honestly, I've heard different advice from different financial people.
Yeah.
If we have current debts, including either, not student loans, but I guess it could be student loans, but maybe a house payment, would you recommend paying off the house prior to investing more than 10% of your income? Or would you recommend that we start building our retirement prior to paying off debts?
So that's a good question. And I'm sure you have gotten a few different answers.
Yeah.
And some of it is, when it comes to this, some of this is personal preference. And I always tell people, what keeps you up at night? My wife is a PA, came out with a lot of debt from DMU. John, his wife is a DO, same thing. And student loans were something that kept my wife up and was more of a priority for her early on. On the house side, what I would say there is some of that depends on interest rate, and how long you're going to be in the house. And the reason I say that, if you have a really low interest rate, I would only pay what you need to there, because you're not paying a lot of interest anyways, and likely anything you invest in you have simple interest working against you on the debt side, where you have compounding interest on the investment side. And each payment you make and dig into that principal, the lower your interest is going to be. Now, if you have a higher mortgage rate, I could see wanting to pay a little bit more towards it, just because you're paying a lot of that interest early on. But if you're planning to be in it a while and you have a lower interest rate, I would say investing would be the better option. And the reason being, that equity that you have in your house, it's illiquid. You're going to extrapolate that if you sell it. But you're also not in control of what the market value is going to be at that point in time. So on that side, I'm always a fan of investing over putting it towards the mortgage. But on the student loan side, that I do give that a little bit more personal preference, depending on what interest rates are. If you're going to be involved in any forgiveness, that could be a little bit different, but they also could kind of go hand in hand. If you're on an income-based repayment, for example, and you're saving to a 401k, well, that pre-tax deferral is going to bring down your taxable income, which is going to make your income-based repayment less. So the levers kind of go together a little bit. But on the student loan side, I can't give you enough conviction to say which way, but I would tell you, always take advantage of any match that you can from an employer plan, and then look to fund a Roth IRA, and then any excess, apply towards your debt repayment strategy, if that's a big thing.
Okay, perfect. Thank you so much.
Yeah, you bet. Good question. And hopefully that was a good answer for you.
It was. I've probably asked 6 different people and gotten 6 different answers. So you know how it is. Yeah.
Yeah. On the house side, did that make sense? So with that, that's just my big concern, is you
Mhm.
are building equity in it, but you're also, it's not something tangible you can put your hands on. Whereas, if your interest rate's under 5% right now, to me, you'd be better off even just putting that additional money that you would apply towards the principal into just a sinking fund, like a money market that's paying 5% APY right now.
Yeah,
Now, when rates come down, so too will those money market rates. But that's also a good thing, because then if you had a higher mortgage rate, you could refinance to a lower rate. But then you also have that extra money. It's tangible on your side of the balance sheet that you can put your hands on and repurpose towards whatever your goals might be,
right. Thank
or
you.
put less pressure on getting X amount out of your home.
Right. Gotcha. Thank you.
Yeah, thanks for the question.
Excellent. If we don't have any other questions, then we will let everyone carry on with their day. This will be posted in the educational portion for people who want to do the replay. And thank you to Matt for joining us today and schooling everybody on the things that we all need to know but don't actually understand. So at
No,
least
thank you again for having me. It was a pleasure, and I hope that people find it valuable.
thanks so much, everybody.
Thank you.
You have a great day.
You too. Thanks,
Bye-bye.
Randy.